The 5 IRS pitfalls that impact nearly every retiree in their first year, and how to steer clear of each one. She had handled her taxes flawlessly for 31 years. Every April, every deadline, every document, never an issue, never a notice, never a letter from the IRS. Then she stepped into retirement. Within 8 months, 2 envelopes showed up, both from the IRS. One claimed she owed underpayment penalties she couldn't explain. The other challenged her Social Security income and warned of extra taxes. Carol hadn't cheated. She hadn't concealed anything. She wasn't manipulating the system. She had simply retired. And that single shift, moving from employee to retiree, completely flipped the tax system on her. The rules didn't just adjust slightly, they changed entirely. The automatic safeguards her employer managed for 3 decades vanished overnight. Size. And the IRS didn't send her a friendly notice saying everything you knew about taxes has changed. Instead, they sent letters with deadlines, with penalties, assuming she already understood what had shifted. This video will walk you through the exact 5 areas where the IRS applies much tighter scrutiny the moment you retire. The 5 traps that catch most people in their very first year without a paycheck. These aren't minor slip-ups. They create unexpected tax bills, penalties that build each quarter, higher Medicare premiums 2 years later, and months of stress handling IRS correspondence. If you're retired, getting close to retirement, or helping older parents manage this transition, stay with me until the end, because the 5th trap alone has quietly cost some retirees more than $15,000 in a single year, and almost no one mentions it until it's already too late. Let's begin. Introduction 130-330. This is for educational purposes only and is not tax or financial advice. Always consult a qualified tax professional and review your specific situation before making any decisions. Carol worked as an accountant for 31 years. She understood the tax code thoroughly. She prepared returns for clients. She filed her own taxes every April without a single issue. She retired in June 2024. By February 2025, she had received 2 IRS notices she had never encountered in her entire working life. One addressed estimated tax penalties. The other pointed to a withholding discrepancy on her Social Security income. Neither notice was disastrous, but both cost her time, money, and the unique anxiety that only an IRS envelope can create. Carol hadn't done anything differently in retirement than she had while working. The issue was that the IRS had shifted the goalposts. The rules that governed her tax life as an employee had changed in ways she didn't recognize the moment her final paycheck cleared. Her income sources were different. Her withholding situation was different. Her reporting responsibilities were different. And the 5 areas where the IRS applies the most attention to retirement income are areas most retirees have never been warned about. Today I'm going to guide you through those 5 specific areas in detail, with real examples, exact forms, deadlines, and penalties involved. These are the traps that turn a smooth retirement into months of stress, surprise bills, and confusing IRS letters. If you've just retired, are about to retire, or have parents who recently stopped working, this video could save you thousands of dollars and dozens of hours of frustration. More importantly, it will show you exactly what to set up before filing your first retirement tax return so you never receive those notices in the first place. Let's dive in. Trap number 1, withholding stops automatically. 330-1030. The first change that happens the moment you retire is withholding. When you were employed, your employer withheld federal income tax from every paycheck. You completed a W-4 form when you started the job. You selected your withholding level. And for the rest of your career, the system operated on autopilot. Taxes were taken out before the money ever reached your bank account. Most employees didn't face a large bill at tax time because withholding had already covered most of their liability throughout the year. The moment you retire, that automatic system ends. Your retirement income now comes from multiple sources, and none of them automatically withhold taxes the way a paycheck does. Social Security offers voluntary withholding. You must request it. IRA and 401k withdrawals have optional withholding that you must select at the time of each distribution. Pension income requires a separate form called W-4P that many retirees never complete. Investment income from dividends, interest, and capital gains has no withholding at all. Rental income has no withholding. Self-employment or consulting income has no withholding. The result, most retirees enter their first retirement tax season with a significant underpayment they never expected. And here's the part that surprises people. The IRS expects you to pay taxes as you earn income throughout the year, not in one large payment every April. If you underpay your taxes by more than $1,000 during the year, you may owe an underpayment penalty on top of the tax itself. For 2026, the underpayment penalty rate begins at about 7% for the first quarter and 6% for the second quarter. These rates adjust quarterly and compound on the amount you should have paid but didn't. The safe harbor rule. Before I explain how to fix this, here's the IRS safe harbor rule because this single guideline determines whether you'll owe a penalty or not. The IRS won't charge an underpayment penalty if you meet one of these two conditions. Option 1, you paid at least 90% of your current year's tax liability through withholding and estimated payments combined. Option 2, you paid 100% of your previous year's tax liability. If your prior year adjusted gross income exceeded $150,000, this increases to 110%. This is why the easiest strategy in your first retirement year is to review your prior year tax return. Find line 24, which shows your total tax, and ensure your combined withholding and estimated payments for the current year equal at least that amount. You may still owe some tax when filing if your income changed significantly, but you'll usually avoid the penalty. How to fix your withholding in retirement. The solution is simple, but almost no one sets it up automatically. For Social Security income, file Form W-4V with the Social Security Administration to request federal withholding. You can choose 7%, 10%, 12%, or 22%. For pension income, file Form W-4P with your pension administrator to set withholding at the correct rate. For IRA withdrawals, request withholding each time you take a distribution. Many custodians default to 10% or 20%. Verify what they are actually withholding. For income without automatic withholding, dividends, interest, capital gains, rental income, consulting work, make quarterly estimated tax payments using Form 1040-ES. The estimated tax deadlines for 2026 are April 15th, June 15th, September 15th, and January 15th, 2027. Missing even one quarter triggers a separate underpayment calculation for that period. The IRS does not average your payments across the year. If you pay everything in April, you will still owe penalties for the earlier quarters. The after-tax pension contribution trap. There is one more withholding issue that affects many government and defined benefit pension retirees. Many pensions include a portion of after-tax employee contributions. That portion of each payment is a return of your own money and is not taxable. The IRS refers to this as the simplified method or cost recovery. The worksheet appears in IRS publication 575. If you have a pension from a job where you made after-tax contributions and you've been reporting the entire payment as taxable, you are likely overpaying taxes every year. The IRS specifically monitors whether retirees are calculating this exclusion correctly. Get it wrong either way, and you will receive a notice. Real-world example? Let me give you a clear dollar example so this isn't abstract. Robert retired in January 2026. His retirement income for the year includes $36,000 in Social Security, $24,000 from a pension, and $18,000 in IRA withdrawals. His total income is $78,000. When he was working, his employer withheld about $14,000 in federal income tax during the year. Robert set up no withholding on his Social Security. His pension withheld $2,000 at the default rate. He took his IRA withdrawals without withholding. When Robert files in April, his federal tax liability is around $10,500 based on his income and filing status. He's only had $2,000 withheld all year. He owes $8,500 at filing plus an underpayment penalty because he didn't make quarterly estimated payments. The penalty isn't massive, but combined with the unexpected $8,500 bill, it's a major shock for someone on a fixed income. Robert made no mistakes. he broke no rules. He simply didn't set up the replacement withholding system that his employer had managed automatically for 30 years. Trap number 2, Social Security income is now closely monitored. 1030-1630. The second major change is how the IRS tracks your Social Security income. Every January, you receive Form SSA 1099 showing your total benefits for the previous year. This form is sent to both you and the IRS. The IRS already knows exactly how much Social Security you receive before you even file your return. What the IRS specifically watches is whether you correctly calculated the taxable portion of those benefits and reported it accurately on line 6B of Form 1040.